Good evening and welcome to the first episode of The No Nonsense Investor. Warren Buffett is the most famous investor in the world. $1,000 invested with Buffett in 1965 would be worth well over $27 million today. So it's easy to see why investors all over the world want to know how he was able to achieve this and what his investment strategies were. Now, most of us are familiar with Buffett's most famous quotes. For example, be fearful when others are greedy and be greedy when others are fearful. And another famous quote was rule number 1, never lose money, and rule number 2, never forget about rule number 1. However, what most investors aren't aware of is that Buffett had a primary investing ratio. And what's more surprising is that most of the investment community has almost completely ignored this. Now, this might be because the ratio was only quietly mentioned over 40 years ago in one of the many annual reports of Buffett's company Berkshire Hathaway. But what's truly remarkable is the few super investors who are aware of this ratio. They've used it to beat the market again and again, even decades later. So in this episode, we'll reveal and explain Buffett's primary ratio, along with how you can start using it today to separate winning stocks from losers. If you're enjoying the channel so far, please click the like button and subscribe to the channel, as there'll be plenty more videos to come. Anyway, to business. How do you know if a stock is a winner or a loser? And how do we best judge what makes a great business to invest in? What's the primary test of this? Well, in his 1979 annual letter to Berkshire Hathaway shareholders, Warren Buffett said the following: "The primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed, and not the achievement of consistent gains in earnings per share." Another way of phrasing this is return on capital employed, or ROCE, sometimes referred to as ROCE. But what is ROCE? Well, in plain English, ROCE tells you how efficient a company is at making money. The formula is EBIT divided by capital employed, where capital employed is the total assets minus current liabilities of a company, and EBIT is earnings before interest and tax. ROCE tells you the amount of profit a company generates from each dollar, pound or euro that it uses in its business, whether it's from debt or equity. The more profit that can be generated per dollar invested, the better. And generally, a ROCE above 25% is considered strong. Let's see an example. If a company has £1 and then invests that pound in its business, earning 30p profit on that pound, its return on capital employed, or ROCE, would be 30% and would now have 130. Sounds simple enough. But we also need to keep in mind its cost of capital. This includes paying interest on debts, paying dividends, and doing buybacks for shareholders. These factors, among others, are part of a company's WACC, or weighted average cost of capital. And this sum can be difficult to calculate definitively in the real world, so it must usually be estimated. Here we're conservatively assuming the cost of capital is 10%. Now, as you can imagine, the ROCE needs to be at least equal to the cost of capital for the company to break even. A company with a ROCE consistently higher than the cost of capital will gain in value, while a company with a ROCE consistently lower than the cost of capital will destroy value. Well, when we deduct the cost of capital of 10%, the company finishes the year with 117. Now, this is where it starts to get interesting. If the company has a source of growth, meaning that it can then reinvest some or all of these earnings back into its business at a similarly high rate of return, the returns compound over time. Assuming the ROCE of 30% is maintained consistently, the company finishes the second year on 137, and in the third year finishes on 159, and in the fourth year finishes on 187, and so on and so on. The results of this compounding effect are more impressive the longer the time period. After 10 years, the initial £1 investment has compounded into over £4 excluding any dividends. So no wonder Einstein described compounding as the eighth wonder of the world. This is the most important thing equities do. When you buy a business, the company takes your money and invests it for you on your behalf in its business at a high rate of return, and it can then reinvest the proceeds again and again, compounding in value over time. It's important to note that this is a unique characteristic of equities as an asset class. This doesn't happen with bonds, real estate, gold, or cryptocurrencies. So now we're going to compare two companies, General Electric, the US energy conglomerate, and Domino's Pizza, the US pizza delivery chain, and we're going to see how you can use ROCE to pick the winner and avoid the loser. The first thing you'll notice when you look at these figures is that General Electric is clearly the bigger company of the two. It has overall earnings over 10 times higher than Domino's. However, notice that GE has had to employ over 130 times more capital than Domino's has to achieve these earnings. Domino's is therefore over 10 times more efficient at employing capital than GE, and this is reflected in its high ROCE of 68% compared to just 4% for GE. Now, what's important to remember is that 10 years ago, GE stock may have seemed cheap to some investors with a low PE ratio of 9.1. But like many lowly rated stocks, it turned out not to have been lowly rated enough. Over the last 10 years, GE has averaged a ROCE figure of just 2.8%. This sum is almost certainly significantly below what its cost of capital would have been during that time. So we can see why GE would have struggled to make much money at all during this period. Quite simply, its cost of capital has outweighed its returns on capital, and therefore it's no surprise that over the last 10 years the share price has declined significantly. Domino's Pizza, on the other hand, has been a very different story. It's consistently made very high returns on capital over the last 10 years and has been able to grow significantly in that time, reinvesting that capital during this period and compounding in value as a result. In fact, since January 2010, Domino's stock has increased over 4,000%, outperforming Apple, Google, Microsoft and Amazon during that time. If you'd have invested $25,000 in Domino's in January 2010, you would be a millionaire today. At this stage, it's worth considering a quote from Charlie Munger, Warren Buffett's investment partner. He said, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make a much different return than 6%, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 to 30 years, even if you pay an expensive looking price, you'll end up with a fine result. What Charlie Munger is saying is that in the long term, what matters is the return on capital the company generates over time and not the price an investor pays for the stock. Now, Domino's Pizza isn't the only ROCE hero out there. Here's a list of 10 other companies which have used a high return on capital employed to crush the market over the last 10 years. As you can see, these companies are from different countries and from different sectors. What these companies do all have in common is they make high returns on capital employed, and they all have sources of growth, so they can reinvest that capital at similarly high rates of return and compound in value over time. One investor who uses ROCE in their strategy to beat the market is Terry Smith, manager of the UK's largest investment fund, Fundsmith Equity. As of December 2021, Fundsmith has achieved a 570% or 18.6% annualised gain since inception, which is not far off Warren Buffett's average annual gain of 19.1%. In a recent interview, Terry stated that providing we do not depart in our mantra of owning very good companies that make high returns on capital, typically in the high 20 to 30% bracket, that can then reinvest some or all of that capital to grow at that rate, the returns of the fund will gravitate towards the returns on capital in the companies. I'm not putting that forward as a theory. It's a fact. So today we've heard from super investors Warren Buffett, Charlie Munger and Terry Smith, and all regard ROCE as important, if not the most important factor to look at when judging a business. And providing they have a source of growth which allows them to reinvest that capital at similarly high rates of return, companies are likely to do incredibly well. If you've enjoyed this video, please consider liking and subscribing to the channel. There'll be plenty more videos where this came from. And of course, no nonsense.